Okay. I'm gonna start off with just letting you guys know that I'm gonna start doing them in video format now instead of doing the live. Uh, just so I could try to keep the video just about this. I think it'd be better because sometimes I have like a lot of background noise when I'm in the Discord chat or whatever. But anyway, so this one's gonna be about trading price action trends, chapters 15 and 16, which goes over channels. And here's the slide references. For the last slide today, I didn't really see anything that stood out to me for Al's wisdom. But I would recommend reading both these chapters because he puts a lot of charts in the book, and he does go into like deep dives about it. And I think channels are so common that it's definitely worth reading everything he has to say about it. But moving on, so what is a channel? So a channel is just trading that is mostly confined between two lines. Al calls like what you would consider like a normal trading range, up and down, he calls that a channel. And he says if it's angled, that is a corresponding directions channel. So if it's angled up, it's a bull channel. If it's angled down, it's a bear channel. And you can draw them when the two-legged move has similar sized legs and it reverses. So what does that mean? So this is from Friday, yesterday's price action, which was a bear trend day. And we ended up channeling up in the middle of the day, which is pretty common to get a bull channel after a bear trend opening. So when it's acceptable to draw is after you see, for example, like a wedge and you expect two legs sideways to up on a day like Friday. If those two legs after their pullbacks are similar size, then we're probably going into a bear channel, or sorry, a bull channel in this example. So bars 24 and 26, you see how they're similar. That is probably why we began to channel rather than just get trend resumption down or trend rate of trend reversal. So how do you trade them? And realize that all of these things apply for the bear channels as well. You just flip it. But specifically we'll be talking about bull channels here. So channels are trading ranges and you want to buy low, sell high. And I really like it when we get overshoots and then you take a counter trend trade. I didn't put any overshoots here, although I put a lot of overshoots in the Discord, but bar 29 is an overshoot, bar 45 is an overshoot. They're everywhere. So those are my favorite. But there are two general things you can do. You can short the top trend line and buy the bottom trend line. Al specifically says to, and we'll go over it, he specifically says to look for high 2, but that's in the next slide, so we'll stay on topic here. But you could short this overshoot, right? Maybe with 2 or 3 contracts, take quick profits at the middle of the trading range, or maybe 5 ES points for a scalp, leave a runner, and then wait for a breakout. Or you can go to break even with your runner. If you can stop break even, it is what it is, right? Oftentimes what will happen is in a bull channel, for example, you get 3 pushes up, and a bear channel you get 3 pushes down, and then the market will start to look for reversals. In a bull channel, you can look for low 2s and low 3s. So here, low 1, you get a scalp. Low 2, this low 2 fails. That's very common in my opinion for a bull channel, so I kind of stay away from doing this, and I would rather either short the overshoot or buy the overshoot or sell the close on a bear breakout. So the low 3 short here after the 3 pushes up works. You get a low 3 short, and if you're brave enough to take it, you are rewarded greatly, although I would not take that trade. Characteristics of channels, they're often bull flag or bull channels, for example, often bear flags in higher time frames. Most of the time they would test above the top of the second leg. So I'll go back to this slide real quick. So you have one pullback, two, kind of like a two-legged pullback here, but we ended up getting above the second leg almost immediately. So very common. You usually have at least 3 pushes up. If the third leg breaks out above the second and that bar turns into a bear bar, often traders will short aggressively, expecting the overshoot to break out to the downside. And that's why I like overshoots, because it kind of just keeps you out of, messing around with this, and the overshoots are very clear to fade. And even if the breakout is successful, right, a lot of times you can get out with a small loss because you usually will get a retest of the trend line. So the option is usually there. When the market breaks out of a channel, usually the first target is a measured move. So I wanted to show this on my actual NinjaTrader. Again, same channel. Breakout bar 56. When we do a measured move from the height to the bottom of the body, which is how Al measures. Look, first target was 42.60, and the bears got it with bar 59. Or sorry, no, they did not. They got it with bar 60. They got it, and look, you see some buying going there. More than likely, shorts covering, but still, that's how I would measure that. Moving on to chapter 16, micro channels. Micro channels are really tight channels between 2 lines, and usually all of the bars will be touching it. It doesn't have to, but they'll be very, very close. They often occur on breakouts, but they can occur anywhere. You'll see when we get into the micro channels, Al really likes with trend trades on them because they are a sign of strength. But he does talk about in this chapter, don't ever forget your context, because they can happen on any time, right? They just usually happen on breakouts. But if they're happening in the middle of a trading range, it's still not a good idea, to buy high or sell low. So always remember your context. But anyway, we break out we break out to the downside Thursday's low on Friday, which was yesterday, and we have a tight bear channel. Usually you get about 2 to 10 bars of this. In this case, we have 1, 2, 3, 4, 5, 6, 7, 8 bars of this before the bulls were able to reverse. But as you can see, first reversals in tight channels often fail, and bar 13 failed. And we're going to talk about it on the next slide. So how to trade. You look for a pullback. First pullback often fails in tight channels that have 5 bars or more. Well, you can see it here. If after the pullback the leg does not close above/below the previous high or low, oftentimes it is a double top or a double bottom buy sell signal. So what does that mean? If, for example, bar 14 doesn't close below, if we don't ever close below the bar 13 low, which was the low of this channel, so I can extend this out a bit further, which is the low of this leg, oftentimes you'll get a double bottom buy signal, or maybe a higher low or a lower low major trend reversal buy signal. That's why the close is important. But yeah, not as much to say on the micro channels. Although the chapter's long, but it more or less the most important thing you should note about micro channels, in my opinion, are they are a sign of strength usually, especially after a breakout. So if you have a micro channel and you see 4 or 5 bars in the micro channel, it's okay to, in this case, bear micro channel, sell the market, or just wait for a pullback. It's up to you. And again, I didn't have anything in particular to say from what he was talking about. He talked a lot about machines in this chapter and channels and stuff, so nothing profound. But yeah, I'll get this uploaded as soon as I can. See you guys later.